What is the neutral interest rate? Have you ever wondered what keeps our economy balanced? One key player in this balance is the neutral interest rate. This rate is the real interest rate adjusted for inflation. It is the rate that neither stimulates nor restrains economic activity. Imagine it as the sweet spot where the economy operates at full employment and maximum sustainable output while keeping inflation stable. So, what does this mean in simpler terms? The neutral interest rate is where the economy can grow steadily without overheating or slowing down too much. It balances the total demand and supply in the economy. However, we cannot see this rate directly. Instead, economists estimate it using various economic models and factors. These include gross domestic product growth, productivity, demographics, and savings behavior. Central banks like the Federal Reserve in the United States use the neutral interest rate as a benchmark when setting monetary policy. When central banks set interest rates below this neutral rate, they create an expansionary monetary policy. This encourages borrowing and investment, which can stimulate economic growth. On the other hand, when rates are above the neutral rate, the policy becomes restrictive. This slows down the economy to help control inflation. The concept of the neutral interest rate dates back to economists like Knut Wicksell in the late 19th century. He described it as the interest rate that keeps commodity prices stable. Today, modern central banks relying on this concept to determine whether their policy stance is accommodative, neutral, or restrictive. In the context of capitalism and financial systems, the neutral interest rate plays a vital role. It helps balance the incentives for saving and investing. This balance is essential for ensuring that capital allocation through financial markets supports sustainable economic growth. It prevents excessive inflation or unemployment, which is crucial for capitalist economies. Central banks estimate the neutral rate to decide how to adjust short-term interest rates. For example, if inflation rises above the target, the central bank may raise rates above neutral to cool demand. Conversely, if growth slows and unemployment rises, rates may be lowered below neutral to encourage spending and investment. In an open economy like the United States, the neutral rate also reflects international factors. These include the country's net savings position and investment flows. Higher neutral rates may be needed to encourage sufficient saving and investment to meet future debt obligations and maintain economic stability. Overall, the neutral interest rate is a foundational concept in monetary policy transmission mechanisms. It guides how central banks influence economic activity through interest rate adjustments, ensuring a balanced and stable economy.